I think the best thing to do is to understand how money works, what money is, and to design a portfolio that requires your understanding. If you do that, then you have a precious metals component that basically will see you through no matter what the conditions are. And these questions become somewhat secondary, meaning because you have a sound basis for how you structure yourself financially. Yeah, things can come and go up and down, and yet you know that your ship is sailing majestically across the ocean because you have built it in the right way.
Welcome to the Gold Exchange Podcast, where we untangle market and policy complexity using timeless economic principles. For show notes and archives, go to goldexchangepodcast.com. Welcome back to the Gold Exchange Podcast. My name is Benjamin Nadelstein. I'm joined by the publisher of the Morgan Report, David Morgan, the one and only. David, how are you doing today?
Doing well, Ben. Thanks for the invitation.
David, great to have you. Lots of your analysis has been out on the interwebs, talking about gold, talking about silver. Before we start, let's get a 50,000 overview on where we are in the precious metals markets. Most people said, well, interest rates are high. That's bad for gold and silver. The stock market is high. That's bad for gold and silver. And, political tensions, those are dying down. And geopolitical tensions, those are dying down too. So pretty much everything would put a damper on the price of gold and silver, which generally tend to move with those markers. And yet, gold has hit all-time highs as well as silver having a nice rally as well. So why do you think the precious metals have been doing so well despite all these indicators saying maybe they shouldn't be?
Great question. And the answer is because they know what's ahead. I mean, gold and silver really are forecasting the future. And the future is more problems in the financial sector, more problems in the monetary realm, more instability in the markets, more uncertainty in the markets. And the one tangible wealth item that we all know that exists is gold and silver. It's often said that gold is the only monetary asset that doesn't have a liability or a counterparty risk. And that's true, but it's not only gold. It's gold, it's silver. And in reality, it could be, a lumber yard that's bought and paid for, but, lumber could warp, it could, rot, termites could get to it. I mean, the two monetary metals are the monetary assets that aren't liabilities. So it's forecasting what's coming. If you think about what you just said, I know you did, but for the audience, and gold is the most negatively correlated asset to the stock market, and the stock market's making new highs, and so is gold at the same time. I mean, logically, you could say, well, if stock market's making new highs, gold could be making new lows, or wallowing around, or unable to break a certain ceiling, or whatever. And that's not true. So under these conditions, it's doing that well. That should actually scare you. That should actually, if you think about it logically, would give you the thought, wait a minute. If that's the case, then what does lie ahead when the stock market falls off? The real estate market implodes further with the commercial real estate bubble. What happens if the bond market really doesn't do any better because interest rates are actually raised further and not lowered? And these are all contemporary problems that you and I both know exist, but yet you see the mainstream never really touch on these topics. So thank you for that opener. I really like the question.
Yeah, and for most people, one way to think about it would be if your house is fine, it's a great sunny day, and you're calling up your insurance agent saying, I need to buy more insurance. Well, most people would say, huh? If it's a great sunny day and everything seems fine, why are you buying more insurance? Why are you topping off extra housing insurance? And the answer might be that you're looking ahead and thinking, well, the insurance I have right now is not enough. Maybe that's why there's a bid on the precious metals. So, on that bid, on the demand for precious metals, it seems like American and US demand for the precious metals is actually not super strong, not incredibly robust, and that lots of demand is coming from other sources around the world, since other buyers of precious metals can be from India, China, you name it. So, where do you see the kind of foreign demand versus domestic demand in the US? How do you see that playing out and playing out in the future?
Well, most North Americans look at the dollar priced in, US dollars. And when they see what's gone on and they've seen such a gully in the market, a downtrend, you could say, from 2011 basically until recently, many people are just burnt out. It's called a round trip. For example, if you bought gold in September 2011 at the all-time high of approximately 2000, and you waited all the way to 2024 and it got back to 2000, maybe 2100, 2200, and you said, you know what, I bought too much gold, I wish you didn't own it or whatever, and you exited the trade, that's called a round trip. Watch it go from 2000 to 2000 over that decade and more. And so there's a lot of that. I don't know how much is a lot, but it's substantive because the wholesalers are really full of metal, as you well know. And the bids have come off, the spread has come way down. And that's a direct indicator of inventory supply, which is really big. So that's part of it. I think the other side is that the other part of your question is what are the foreigners doing? Well, they're seeing what's happening in the dollar. They're seeing, what's gone on with peer-to-peer currency exchange for oil, for example, between China and Russia. They're seeing what's going on for Brazil with direct links to their currency. So once the BRICS get further established and they're able to have multiple currencies in their basket of trade, where they don't have just Chinese yuan and what do you do with it, when they can exchange that for the Brazilian real and other currencies, they've got a pretty big market. And I think the basis of their knowledge of what's going to go on with the dollar, which still most of the world's debt is dollar based, which means you're not going to be able to pay it off in real or rubles. You're going to have to exchange it for dollars. So they see what's coming. So they're hedging their bets or forecasting or taking action, I think is the best word, taking action against basically the inevitable. All currencies meet the demise of fiat, which is an unbacked edict by government that demands you use the script as payment in full. And yet, as it deteriorates to the point of oblivion, where it's worth less and it's worth less, it's worth less, and it's perceived to becoming worthless, that's when you see an acceleration in these markets. And I think the foreigners are just starting to get their nose out of the tent for this, what I think is a third and final leg up in the precious metals, which is always or always has been the greatest gains in terms of percentage. And usually the frequency is small, meaning the time duration is actually smaller than the other two legs. And if that's true, and I believe it will be, what we'll see is a mass exodus out of currencies generally into precious metals. And that would be accelerated if or when stock markets, bond markets, real estate markets, and every other asset class that's held dear at this point starts to go the other direction. And as we both know, the metals markets are so extremely small relative to what some of these other markets are. The amount of potential investment into these markets is so phenomenal that I believe what I've said many times, that this next run to gold will probably go into the financial record books.
And I think one way to see that microcosm play out is in the Chinese retail market, not talking about central banks, but Chinese retail market, where some, investors and just everyday people, citizens have said, okay, putting more money into Chinese real estate seems very iffy. Who knows what's going to happen to that market? It's obviously been crashing for quite a while. But do I really want to throw, good money after bad there? Potentially not. Then they look at their own stock market. Okay, potentially volatile as well. Do I want to throw even more good money in the stock market? And then they say, okay, I definitely don't want to hold on to yuan because it's depreciating over time. It's, not a strong currency. It's not used internationally. I can't really do anything with it. And so they can't go out and buy dollars or hedge their currency exposure. So they have been left with the contra currency, as Bob Elliott calls it, which is gold. And of course, silver can also be thought of as well. So maybe that exact type of scenario on a small scale can play out on a larger scale in places with larger markets and stronger markets like the US market, the European market, the Japanese market, and so forth. And you've seen, for example, the Japanese market, the Japanese bonds looking precarious. So maybe people are going to start saying, you know what? Time to add a little bit of extra gold and silver into my portfolio as a hedge.
Ben, I like that. Well said. And I just want to add on one comment. When when the silver situation with the Hunt brothers ended, there was an article in Barron's. You were too young, you didn't see it, but it was Hunt versus a billion Indians. So the idea was that, the Indian population of India has vast supplies of silver, and Hunt couldn't possibly corner the silver market. But let's take this reciprocal of that. The central bank versus a billion Chinese. What happens if, those billion Chinese, 10% decide they want gold and silver? So it works both directions. Is this what I'm implying? What you said, I just wanted to reaffirm it. I don't know why that popped in my head, but it did.
And that's a great point to think about too, which is for every buyer, there's a seller, and for every seller, there's a buyer. But one thing to think about in the precious metals is something called the stock to flow ratio, which is that over time, gold and silver barely erode at all. They can last for thousands and thousands of years, which is partially why they've been considered money for thousands of years. They don't erode, they don't rust. And so you can hold on to them. They're small, they have a high, value to low weight ratio. And so for many people across different currencies, across different countries, across different times, have held on to gold and silver. Now, they're probably not going to report, hey, everyone, I've got 10 ounces of gold in the basement, or I've got 1,000 ounces of silver just sitting around. So when the price of that metal does go up, you can, of course, find sellers that you didn't think existed. But on the other hand, you can find lots of people who are potential buyers when they see, for example, their own currency, like the rupee, falling. And that means even if a small percentage of those people, let's say in India or China or other markets, say, I'd like to add to my gold or silver holdings, in terms of percentage, it can be small, but in terms of numbers, it can be quite large.
Exactly. And I'm going to veer off of that a little bit, but you reminded me of 2020 in the silver market. In 2020, the amount of demand was an all-time record. The ETPs or ETFs was 320 million ounces. The retail demand was over 200 million ounces. You add those two together, you get over 500 million ounces. That was an all-time record on demand. And I really scratched my head. How was that demand met? All of that is purportedly physical. And what I determined, it took a little while, but I got there, was that in terms of the foreign exchange, which remember, we talked at the beginning, in terms of US dollars, the gold price is this, making new highs. But it made new highs in almost every other currency on the planet. Anyway, back to my point, in 2020, the rupee, the silver price in rupees was at an all time. And they were not doing well in the nation of India. And a lot of people either wanted to sell because it was an all time high or needed to sell and it was an all time high. So I largely believe a lot of that liquidity for physical that was necessary for that year came through the fact that in the rupee, silver had hit an all. And this is something people don't really consider that often because most of our listeners are North Americans. I've got a global audience. Subscribers to the Morgan Report come from 72 different countries. But regardless, the idea being that, the US dollar is everything, it's not. But this is the reason you can see these flows because in their currency, it's worth doing or
Now
perceived.
let's quickly talk about the difference between gold and silver. They're both monetary metals as well as precious metals. But do gold and silver have the same narrative going forward for 2024? One thing to think about is that gold is generally traded amongst capital assets. So if you sell your house, maybe you can buy some gold because of those proceeds and the size you'd like to buy something that is like gold, versus if you're a wage earner, maybe instead of storing your paycheck in gold, which is a very small amount, you might be storing part of your paycheck in silver, which, gets you more sizable coin or bar or something like that. So for the rest of 2024, do you see that narrative for gold and silver playing differently? Do you think the metals are going to rise or fall together? Or do you think that there's actually going to be a shift between gold owners and silver owners with the way 2024 plays out?
Well, I'm going to be very close to what you outlined, Ben, but I will say that the overall picture, I think, has changed. First of all, from a legal aspect, it changed in 1873 when the powers that be said, silver is no longer money. We're on a gold only standard. Of course, a few years later, that really changed. And we still had, silver 9% coins up and through 1964, 65, they no longer existed. I think the monetary demand will accelerate on the silver side as gold becomes more and more expensive. So someone, as you said, sell a capital good like a house, certainly can afford gold in most cases. But most working people that see their savings deplete because of inflation will probably run to silver. Plus, it's cheaper, and the gold silver ratio, if you understand what it really means, favors silver at this time. But I want to add on that going back just 2 decades, 2.5 decades, the amount of demand on silver on the industrial side was 35% of the market. Now it is about 60, you could argue even 65% of the market. Now, those are big numbers. It hasn't doubled in industrial demand, but not, almost. But here's the point. 2.5 decades ago, the total supply of silver was 550 million ounces of mined and recycled silver. Today, it's 1 billion. So that's almost double. So think about what I just said. I know your math mind will work. I think the general audience will understand what I'm saying is that the percentage went up from 35 to 60 at the same time that the amount of mined and recycled silver almost doubled, which shows you that if there was no increase in supply for the last 25 years, obviously there has been, but as a thought experiment, if supply and recycling was flat, industrial demand would take over 100% right now. The point is further that the current rate we're going, and I've got to be careful because my predecessor, Jerome Smith, made a big mistake in his last couple of books he published about where he thought silver was going, because there was a change in technology that increased production vastly from where it had been previously. But if the current mining efforts and recycling efforts remain relatively where we are with the best data we have, then in theory, we could be in a point in just a few years where industrial demand is taking almost everything out of the silver market, which means on the margin, where are you going to supply silverware, jewelry, and investment demand? The answer is from above ground stockpiles. And that's already taken place from 1990 to 2005. We had 2 billion ounces of silver, I'm talking commercial bars, and it got depleted by 1.5 billion ounces 15 years later, a deficit of roughly 100 million ounces every year for 15 consecutive years. And we ended out at 500 million ounces at the end of 2005. And from then until now, the above ground supply has been building up until the last couple of years where we have had these deficits.
And so for some listeners, let me explain maybe the narrative shift and why this is so important. Because if you are a monetary metal, you are being held on as money, right? You're not being used. It's not actually being consumed in any way. If you think about gold, right? Someone's just hoarding it or storing it or using it in some way as a monetary instrument versus let's take something like copper, right? Most people aren't holding copper as a monetary instrument. They're usually holding copper because they're about to use it in some sort of production, piping, wiring, right? Copper is not a monetary metal. It has uses other than being stored as money, right? The same way that most people don't view a house as money, they view it as a service or a good that they can use. And so silver might be changing or slightly changing on the margin who its buyers are and why they are buying silver from a monetary metal where they hold on to it, they use it as a monetary safe haven, a hedge, right?
Right.
Or now maybe this narrative shift is happening where they're using it as a production tool, as a part of a commodity process where they're using it in the same way that they use it for solar panels or many other things. So the demand on who is actually demanding it will also change the supply as well.
Absolutely. And if I could just say, once the industrial users realize what's really going on, they will act like monetary purchasers. Let me explain. Your monetary purchaser holds it for insurance purposes, capital appreciation, wealth preservation. I mean, all those things. But one industrial user uses it for solar panels, but that's their business. So if they start buying it and hoarding some of it so they have 6 months supply or a year's supply, so they don't have a threat to their business, not only on price, uh, appreciation, which is minor in most cases. It could double, triple, quadruple, and it really wouldn't affect the bottom line of a business that much because so little silver is used per unit. I know you followed that. I hope the listeners did. But the point being is that they have to get extra silver to stay in business, and that goes through the system. And 60% of the system is industrial. Think of what that added demand on top of people seeing silver's really moving, and the algorithms come in with all the momentum players, which is the vast majority of investors, which I call speculators these days, because it's basically a casino play, not a value investor. And those two things start to be a synergistic move in the silver market. You can see why I could still be excited about the potential for silver going forward.
It's a very interesting point. Now, I'd like to talk about monetary metals and what we do. So, we actually pay interest on gold and silver paid in ounces of gold and silver. The interest rates are actually quoted as an interest rate for ounces. So at 5%, you would have 5% more ounces instead of some dollar price. And that really helps people turn away from thinking, okay, what's the current dollar price of gold and silver? And thinking, how can I acquire more ounces at a favorable risk and a favorable rate of return? So do you think that over time, as more people look at a rate of return on their gold or a rate of return on their silver paid back in more ounces, that will actually dampen the effect of dollar interest rates on the metal prices, where people say, who cares that the Fed is paying 5% on a CD when I can earn 5% on gold or 5% on silver? And do you think that unlocks a different type of monetary demand for gold and for silver?
It'll do both. It will bring reality back to the monetary sphere because you're getting interest on money, not on some script or some edict or something that's always lost purchasing power. And secondly, the idea that you can do better on, let's say, a loan than you could on appreciation. And I want to make this point that the CAGR, the compounded annual growth rate on gold right now, superior to silver, starting from the bottom of the market of about 2000. I think it's roughly 9% for gold, 8 point something. And for silver, it's about 7.8, if I remember correctly. So if you bought silver like I did at the very bottom, and of course I bought it all the, on the way up. I mean, I've got a certain limit. I won't buy it up to a certain price, but regardless, my average cost is well above the $5 level. The point being is that a compounded annual growth rate for 20 plus years at almost 8%. And yet this latest bond that you have available for silver is 12%. I mean, you don't have to go through the ups and downs and all the waiting because that's the compounded annual growth rate over that period where we had this huge, what I'll call slump that we just talked about of 12 years or so. And you're just earning silver on silver, gold on gold. So I think it's something that Keith has spearheaded. We've been supporters of. We've also done a few interviews. We're going to do some more, and just to bring it to the attention of the public, because that's one of some of the drawbacks, especially really wealthy investors. They want to go, wait a minute, I don't know what to do with my money, but I'm parking in T-bills. I'm going to treasury.gov, and I have to do it myself, and my secretary does it for me with my account, and I'm getting 5% or 5.5%. Yeah, I know inflation's really more like 9, but at least I'm not losing everything and it's liquid and, there we go. Well, if you could do that with your, base money supply, meaning money of the ages, gold and silver, then you're sitting in a different position because now you're actually gaining something of value. And that's one thing I have a hard time conveying to several audiences and even myself sometimes. It's like, well, I'm losing, I've lost. Well, you haven't lost until you sell. But the idea is in paper value, it's less than what I paid for it. But it might be more in rupees, it might be more in Canadian dollars. But even ruling that out, the way to really look at it is, do I have more silver than I had yesterday? If it is true wealth, gold is true wealth, and you bought it at 2000 and 2011 at the top, and you come out in 2024 and you have more gold ounces, but the price, let's for talking purposes say it was lower, you actually still have increased your wealth. But that's a hard concept to grasp. But once you start to see that you can get an interest on gold in gold, then you start to stop that mindset because you realize we're talking something real and getting something real, rather than this fantasy that we're all pretending works when it doesn't work at all, and it's starting to break down or break down further, I should say.
And there's two ways to think about that, right? If you are a real estate professional and somehow your renters could pay you in more square footage on your rental unit, you'd be excited because you say, hey, listen, I'm already betting on the price appreciation of a hard asset like real estate. Plus, I can get that rental income instead of in dollars, I could get it in square footage. Now, obviously, that's impossible. No one's going to pay you in more square footage on your house, but it is possible with gold and silver, where you say, hey, I have 100 ounces, I have 10 ounces. I'm going to earn in ounces on my gold and silver. I'm going to have my rental fee or my loan denominated in ounces and paid in ounces so I can actually grow my wealth in a hard asset like gold and silver that have been money for thousands and thousands of years. And one way to think about that is, okay, is it really true that in a place like Argentina or Venezuela that have experienced a horrible depreciation of their currency, that your house has increased in value by 100x? No, of course it's not true. Your house did not become 100 times more valuable if you live in Venezuela. What actually happened was your currency became 100 times less valuable. So the same thing is true of gold. Is it really true that your gold became way more, expensive or priced higher in terms of dollars or yen or euros? It's technically true, yes. But what you're really seeing is the depreciation of the currency, sometimes slowly, sometimes quickly, sometimes with volatility, sometimes the dollar price of gold goes down or up. But you're seeing a slow slide of the value of that paper currency and a strong appreciation or continued stable, constant value of the gold and silver you own. Now the question is, do you want to grow your wealth in ounces or in paper?
Well, couldn't have said it better. Well done.
So, David, I want to ask now as we turn towards the end of the interview here, where do you see the stock market and bond markets and all these emerging markets going? Because most people said at a 5% interest rate from the Fed, there would be lots of havoc in the markets because most people and most businesses, zombie firms, other businesses as well, only could survive in a zero interest rate environment. And now, at a 5% interest rate environment, most businesses, most stocks, as well as most emerging markets wouldn't be able to handle the pressure of a strong dollar and 5% interest rates. Yet so far, things have seemed pretty okay. There's been some stability in the markets. Obviously, there's problems in some areas, but overall, things seem to be going pretty well. So, first, how do you explain that? And do you think that is going to change in 2024?
It's a tough one. First of all, it's partly attributed to the fact of how the indexes are weighted. So you give this appearance, if you're only going to show your football scores, but you only use the top five teams out of the 31 or two that exist, I think it's 31, then you get a different picture than if you look at, let's say, the average. So you can look at like the DJI, the S&P 500 versus the Russell 2000. If you look at the stock market in aggregate over the total, what you'll find is that there's many stocks that aren't even close to their 2-year high but again, the indexes are weighted and manipulated, in my view, to paint a picture that is inaccurate of the total marketplace. So that's point number one. Point number two is that many times in a hyperinflationary environment, you see an increasing stock market. The problem is, even though these people perceive that they're doing okay because they're not in the bank, they're in the stock market, their total return is still negative because the increase in stock price appreciation is not commensurate with the deflationary or the devaluation of the currency. You're better having it in the stock market than the bank, but not by as much as you could perceive. So I gave the idea up that we're going to see more of a deflation in the stock market and actually opened my mind to the idea that perhaps even in the North American or the US markets, NYSE, the Dow, the S&P, even in those markets, we could potentially have a situation where, this $1 trillion every 3 months that we're adding to the debt supply of the US could increase stock prices. So you'd have what's called a hyperinflationary depression. Remember, in a depression, the word depression is pertinent to both a hyperinflationary or a debt deflationary depression. And a lot of things are very similar. And one, high unemployment, high uncertainty, a depressed mood with the populace. And the difference is that in a deflation, the currency gains in purchasing power, but in a hyperinflationary or an inflationary depression, the currency is basically shunned and not able to revive itself, and a new system has to be resurrected. So I wouldn't say I'm leaning either way. What I do know for a fact, and sorry if I'm being long-winded, is in all cases where you have not had specie behind the currency, gold and silver, every time up until now, we've gone an inflationary depression route.
And one way to think about that point you made is that these stock indexes are pushed, or heavily weighted, if you'd like to say, towards big magnificent seven, some people have, dubbed them, where, okay, if Nvidia makes, 400% gains in a year, then it looks like the entire stock market is doing great. If all the other companies don't do so hot and they have a low weighting on the index, then it actually doesn't hurt the index as much, since most people are passive index investors. They see that the index is doing fine and therefore perceive that overall the stock market, which means overall all businesses, are just doing fine. They might even be up for a couple of years. And so maybe your point is, hey, this can continue to go on where we see higher valuations for these smaller, valued companies like Nvidia and Apple and Microsoft. They might continue to increase in value while other mom and pop businesses, Main Street, or even parts of Wall Street continue to flail. But because of that, way the index is structured, it seems like the stock market is all right. And so for most people, things will continue to seem all right, even though the currency as well as markets become worse, structurally less sound, and over time become less valuable.
Exactly.
Okay, so now I want to ask you a question about emerging markets. So some people say, well, there's these BRICS nations, Brazil, Russia, India, China, so on. And they think, okay, maybe those guys will have a stronger economy. Obviously, they have lots of people there, big economies themselves. But on the other hand, there's an argument they have even worse governments, worse rule of law, and worse currencies. So do you actually think there is a threat to dollar markets, the dollar as a currency, as a bond market, and the US, the North American markets? Or do you think that that competition is really lackluster and in general, people will be going to hard assets that are not denominated in a currency like gold, silver, or maybe even something like a cryptocurrency? Where do you see people going? Do you think that there's going to be a competition from these other nations called the BRICS? Or do you think that in general, people all around the world will say, I would like to check out of my government's currency and head towards something more like a precious metals or even a cryptocurrency?
Yeah, that's takes to me my thinking a bit of a nuanced answer. I think the BRICS are gaining credibility and obviously more participation. And if they all agree to trade in each other's currency, that gives them strength. It gives them more flexibility. But at the same time, you pointed out what de Tocqueville pointed out, years ago when he came to the United States, and that is the rule of law, and we have that. China really doesn't. So people that were oh, China centric, let's say at the beginning of the year 2000, early 2000s, and made businesses in China are regretting it today because of that fact. So I think there's always innovation available. Whether the emerging markets are the place it's going to come from, I would say yes and no. I know that's a long answer. I think primarily most innovation still comes from a free market perspective, which the US has lost to a great deal, but there's still a vestige of it here, more so, I think, than most other nations. Not to say that other nations don't come up with some great ideas or inventions or new ways of doing things. On the crypto, I think that's been overblown at this point in time because it's really not of substance in most cases. And because it's really nothing more than a software. And if you get to the reality of what's that there behind there, what's really there, what do you get? It's just like in some of these zombie corporations. I mean, if they cannot get enough cash flow to pay their bills, why would you own that business? Why would you, even think about it? But yet they still are able to generate a loan profile from their banker buddies to exist. Coming back on point, I think it's going to be the precious metals and crypto as probably a second choice. Emerging markets, I think, will flutter in there because the perception will be they're cheap, they're inventive, they're where capital is flowing. So it'll kind of be a follow the leader type of situation on a momentary basis. I still remember the Asian currency crisis. I'm that old. And I remember when everything was, the foreign markets, the Asian markets going east, and that blew up in their face. So I think the best thing to do is to understand how money works, what money is, and to design a portfolio that requires your understanding. If you do that, then you have a precious metals component that basically will see you through no matter what the conditions are. And these questions become somewhat secondary, meaning because you have a sound basis for how you structure yourself financially. Yeah, things can come and go up and down, and yet that your ship is sailing majestically across the ocean because you have built it in the right way.
Where do you see the potential marriage or relationship between this blockchain, cryptocurrency technology and gold and silver, which have, usually been money or thought of as a monetary asset for thousands and thousands of years, marrying the history and the kind of provenance of gold and silver, where people trust them, they understand how they work and why they work, why they have value, and the technological benefits, the more advanced technology that is coming out in the blockchain and cryptocurrency space. Do you see that there's going to be some sort of marriage there between the two, or do you think that they're going to continue to be separate asset classes for a while?
Well, I made the bold statement, and I think that will be the next major leg up in the crypto world is asset-backed crypto, where you have digital gold and silver, and you could have platinum, palladium for that matter. And the reason I say that is, all of the problems, quote unquote, problems with physical gold and silver. I mean, you go back to when the governor of Utah and other states have said you can use real money, gold and silver, in any transaction in this state, anywhere, as long as both parties agree. Well, the problem is if you go to Walmart, first of all, they have to agree, but let's say they do agree. So now you put down, 20 silver ounces. What do they pay you your change in? Fiat? Okay. What price do they take? Do they get on their phone and see what the exact spot price is at in Chicago that just changed by 20 cents because there was a trade made? So there's a lot of cumbersome ideas surrounding actual. Now, in a one-on-one transaction, if I want to buy your car and you want to take my silver for it, we can negotiate it, find a price. We know the price fluctuates, but that's a little different than going to the grocery store or a hardware store or something like that. So the point is, if you put it in the blockchain, now you all agree under contract that we will use the closing price of the afternoon fix in London as the price. So now we all agree it's a price. So you don't have to worry about what's the exact spot price at this moment in time. And then what you do is you just basically move it from a depository that could be state run into whoever's account you are debited out of, or the debiting from your account and crediting the other account. That would work perfectly. And it actually blends with the system that most millennials, like my daughters, are familiar with right now. They go into Starbucks and buy a coffee with gold. It's immaterial to the barista whether or not they pay with gold or fiat. And we actually have a system like that here in Spokane. Unfortunately, the bank is not taking any new members, but it's a debit card based on gold and silver. And we do it on the fix at the end of the day at London. And it is just a paperwork entry and it's transparent to the banking because you're issued a debit card, which would be the same as on your phone. So I think that it will happen. It is happening. It's just not widely adapted, or excuse me, adopted. But I think it will be, or it could be. And I think that your generation, more and more, I mean, it really pleases me a great deal that more and more are seeing the reality of where we are and where we need to go. And I think once that becomes more well known amongst everyone, particularly you guys that are the hero generation that have to rebuild the mess that was left to you by a fiat system that no one was able to rein in, and it'll probably collapse of its own weight. We'll at least have a tool that you can have integrity in the system and trust each other, because the whole system is based on trust, and that's going away rapidly.
And I think one way to think about what monetary metals is doing is we're unlocking that incentive. We're beating that Gresham's law, which, for those who don't know, if you have money that is becoming bad or is worth less, you're more incentivized to spend that, because if it's fixed against something that is good, you'd much prefer to hoard that good. So if gold and silver are fixed at a certain ratio and silver is undervalued, maybe you're going to start spending that and you're going to hoard or hold on to the overvalued, let's say gold. And in this case, if you have gold and silver and you also have a dollar income, you're much more likely to spend the dollar income, because 6 years from now, how much is that $100 bill going to be worth? Well, maybe not that much. But with monetary metals, if you actually earn income denominated in precious metals, you are more likely to say, hey, I earned, X amount of ounces this week. maybe I'll spend a couple ounces on, a latte or maybe a car or maybe even potentially a house. So it really does change the incentive around spending your gold and silver because now you have an income denominated in gold and silver. And so potentially marrying income denominated in precious metals, as well as the technological capabilities and the adoption to actually pay on a network the same way they use the financial rails of Visa and MasterCard to instead of use dollars and draw on your dollar bank account to draw on your ounces from a vault. And actually, maybe I'm not sure if this story is true. So if it is in the comments, please do let me know. If it's false, you can share the correct story with me. But I remember hearing that in Fort Knox, when central banks had their gold stored at Fort Knox, it was not just the United States who had their gold there. It was also the French, the Germans, so on. And if there was a trade imbalance between, let's say, the French or the Germans, that instead of shipping, their gold all the way to the Germans or all the way to the French, they would simply move it from one cage that said France on it to another cage that said Germany on it or the US on it. And so obviously that is not a great way to change over who owns what, but the system was built on trust. People knew, hey, we have a trade imbalance with the Germans. The Americans will actually move that gold from the German cage to the US cage and so on and so forth. Now, with the invention of blockchain and these other types of cryptocurrencies, you can confirm without this trust a decentralized system where everyone can confirm, yep, it really did happen that the gold went from this vault to that vault. This person owned this and this person owed that. And it was actually settled in real time with a physical good. The marriage of those two, the physical plus the kind of technological decentralized trust, really could be a innovation, like you said, as well as an alternative to this kind of current trust-based paper system where most people have to say, well, I hope my bank doesn't go under. I hope there aren't bail-ins. I hope that the currency remains strong. And for many countries and many currencies, that unfortunately has not been the case.
Well said again. And I will want to add that the potential, I'm working with a cryptocurrency that is gold and silver backed. I won't name it. But the idea with one of our debit card associations that we're working on is to get rewards, and the rewards are paid in gold and silver. Wouldn't that be cool? So you'd have monetary metals, and now all of a sudden you got a Visa card that pays you, 2%, but it's 2% in silver at the end. You know, so there's a lot, I think, coming into the monetary realm, which is exactly what happens at the end of all these great inflations, because people understand what's happening. The innovators, such as your boss, Keith Weiner, come up with ideas. And this idea really isn't new. I mean, let's face it, there were gold bonds. I got a picture of one in my office here. But it's new to you and it's new to me because we never had such a thing for many, over 100 years, I'm sure at least. And now it's that principled idea of sound money and sound interest is back in front of us.
For those interested in learning more about monetary metals, you can check out monetary-metals.com to learn more about earning interest on your gold and silver. David, where can people find more about you and your work?
Well, two places. One is themorganreport.com. The landing page will give you all kinds of features that you could click on, the blog, how to subscribe, how to get a consultation. About Us has a couple films on the monetary problem you can watch for free. And then I'm doing a documentary, and the documentary's at silversunrise.tv. It's mostly on the spiritual side of money, believe it or not, and how much stress it causes people worldwide because poor people are always worried about their money. They don't have enough. How do they get another job? And certainly that's a reality. And the super rich are almost equally as worried as the extreme poor. And the reason being is, who do I trust? Are they going to try to take my money? Is this investment a good idea? What about my bank? Is it sound? They have worries as well. So it's about the stress of money and overcoming that with an attitude of not only, oh, I don't want to get too spiritual, but an alignment with the meaning of being a human and what it means to relate to other humans. That's part of it. The other part is by having a sound system where we all can trust each other. Because if we can't trust each other or trust the monetary system, then our interactions on a monetary basis are, I would say, null and void, but certainly questionable. Hey, you paid me this for my truck, but inflation just doubled. I feel like you cheated me. No, he didn't, because at that time, we both agreed that was fair value. It's just that the value of the currency has been disrupted so quickly that now, you feel that you're a victim. Well, we're all victims of the great scam that you can get something for nothing, because the whole system is based on the fact you can print something and it actually has value.
David, it has been a pleasure speaking with you. I encourage everyone to check out the Morgan Report, and we'll have to talk more when gold and silver move and we see more monetary soundness, more trust in the system. David, great interview. Thank you so much.
This episode was brought to you by Monetary Metals. Monetary Metals is a different kind of gold company. Others buy and sell gold. Monetary Metals operates the Gold Yield Marketplace, a platform of products that offer a yield on gold paid in gold to investors and institutions, and are gold financing simplified, reliable financing denominated in gold with a built-in hedge for gold-using and gold-producing businesses. To learn more, visit www.monetary-metals.com.